U.S. markets and consumers dodged some major risks last week. Hey there, Phil Plourd, head of Insights for Everag. Please be sure to read the disclaimer at the end of this video. Okay, last Sunday night, we were on the edge of our seats waiting to see what would happen to markets in the wake of the U.S. bombings of Iranian nuclear facilities. Would crude oil open sharply higher? Would U.S. equities open sharply lower? Well, when things opened up, WTI crude oil did shoot up, traded to as high as 78.40 per barrel, and U.S. equity indices were slightly lower. But by the time the sun rose, crude oil was down on the day, and U.S. equities were higher. And by the time the week ended, crude was at 67.23 a barrel, down 10%, with a downside reversal week on the chart. U.S. equities? Well, the S&P 500 went on to set a new all-time high, up 3% on the week, wiping out all of the tariff fear deficit that started in early April. So, what does this mean? Well, a few thoughts. First, I'm not sure this story is over, the Iranian story, that is. We could see additional action in the weeks ahead. The peace there could be fragile. We'll see. But for now, we dodged a situation where consumers could have seen much higher gasoline prices if crude oil had gone to $80, $90, or $100 per barrel, and consumer confidence and spending could have been imperiled by a sharp decline in equity prices. Didn't happen. We skated for another week. If you want to follow the story, please subscribe to Phil Plourd's Monday Morning Demand Notes. Drop us a line at insights@ever.ag.